In 2008, the American economy collapsed so hard that people lost their homes, their jobs, and their retirement savings in just a few months. It wasn't some random accident. It was built on a lie that millions of people believed, a lie about houses, mortgages, and something called easy money. I'm Michael Stone, and I've spent the last 8 years watching how money moves and how it disappears. Today, I'm going to explain exactly what happened in 2008 in a way that finally makes sense. Because if you don't understand what went wrong back then, you can't protect yourself from what might go wrong next. This is exactly what the title says, the 2008 financial crisis explained like you're 5 years old. No jargon, no confusing Wall Street terms, just the truth about what happened, why it happened, and what it means for your money today. If you're over 40, you probably remember 2008. Maybe you lost a job. Maybe your 401k got cut in half. Maybe someone you know lost their house. And if you're younger, you've heard about it, but maybe no one ever explained it in a way that actually made sense. I'm not here to scare you. I'm here to help you understand. Because once you see how the system broke, you'll know what to watch for in the future. If you're watching right now, comment your city so I can thank you in the next video too. Let's go back to the early 2000s. The economy was doing well. People had jobs, interest rates were low, and banks were handing out home loans like candy on Halloween. Normally, if you want to buy a house, you go to a bank, they check your income, your credit score, and your job history. If you look like you can pay them back, they give you a mortgage and you pay it back over 30 years. Simple. But in the early 2000s, banks started giving mortgages to people who couldn't afford them, people with bad credit, no steady income, or already drowning in debt. They did this because they weren't planning to keep those loans. They were selling them. Banks would bundle thousands of mortgages together into something called a mortgage-backed security. Think of it like a fruit basket with apples, oranges, and some rotten bananas mixed in. Wrap it in plastic, label it premium fruit, and sell it. Wall Street investors, retirement funds, and pension funds bought these bundles. They were told the products were AAA rated, the highest quality, but many of the mortgages inside were risky and likely to fail. Nobody cared because as long as housing prices kept rising, everyone made money. Banks earned fees for creating loans, investors earned returns trading them, homeowners felt richer as their home values increased. The entire system depended on one assumption: home prices would never go down. Then they did. Home prices started falling. Borrowers who couldn't really afford their homes began missing payments. Foreclosures increased. Banks tried to sell repossessed houses, but buyers disappeared because the market was flooded. Suddenly, those mortgage bundles were revealed to be full of bad loans. No one knew which investments were safe and which were toxic, so panic spread. Banks stopped lending to each other, businesses couldn't get loans, companies laid off workers, unemployment surged, the stock market crashed, retirement accounts were cut in half, millions lost their homes, the financial system froze, and the government stepped in with a $700 billion bailout to prevent a complete collapse. The crisis wasn't caused by just one mistake. It was a chain reaction built on incentives that rewarded reckless behavior. Banks made risky loans because they could sell them. Rating agencies labeled dangerous products as safe. Investors chased higher returns without understanding the risks. And everyday Americans were told that buying any house at any price was always smart. The lesson is simple. When everyone says something is safe, question it. When people claim prices only go up, remember what happened. Another crisis won't look exactly like 2008, but risk doesn't disappear, it just changes form. It could be student debt, corporate borrowing, or something entirely new. If this is making sense, stay with me, because here's what you can do to protect yourself. First, check your emergency fund. Crises expose how quickly income can vanish. Aim for 3 to 6 months of expenses saved. Even starting with $500 is better than nothing. Second, don't treat your home as your retirement plan. Property values can rise, but they can also fall. Build savings and investments outside of real estate. Third, understand what you're investing in. If you can't clearly explain how it works and where the risk is, don't put your money into it. Complex products and blind trust were at the center of the 2008 disaster. Before we finish, comment below and tell me which city you're watching from. If this helped you finally understand what happened in 2008, like the video and subscribe. Next, I'm breaking down why inflation feels worse now than it did 10 years ago and what you can actually do about it. This is Michael Stone. Your money works better when you understand it.